Mortgage rates are up, home prices are up, so we must be in a bubble, right? Wrong. This is Andrew with the S2 Real Estate team of eXp Realty, and this is a topic I've talked about in the past. I covered it a couple of months ago, but it's come back around, and I thought it was worth kind of addressing again. The talk of a housing bubble, the talk of an imminent crash, all kinds of things like that keep resurfacing. So the purpose of today was just to share some updated information with you and to give you some solid reasons why I don't think this is a bubble. I haven't thought this is a bubble, and I don't think things are going to change anytime soon. So hear me out here, as I know that's not what many of you want to hear. I know that the thought is, well, if we just sit on the sidelines, everything's going to kind of go back to normal the way it was a couple of years ago. And unfortunately, I just don't think that's the case. Are there markets in the country that are going to see some adjustments? Yeah, there are. You know, I'm sitting right now in Frisco, Texas. Is this one of them? No, it's not. In fact, I was on a call last week with the VP of sales for Beazer Homes, and he made it be known that this particular area has about 100,000 new jobs a year currently being created. And that's forecast to continue for the next several years. And by their calculations and their studies, for every 2 new jobs created, they need 1 house. That's 50,000 homes a year. That's a lot, right? And I mean, where are they going to come from? So over the weekend, I happened to see a report from Yahoo Finance, and it was talking about the housing market and whether or not we are in a bubble. And again, DLB Financial Services CEO Debbie Boyd is the person that they were talking to. This was a live show, Yahoo Finance Live. You can go ahead and find that online, and you can see the actual interview as it took place. And I quote, this is what Debbie had to say. We have to quit thinking that this is a bubble and just start thinking that this is it now. This is the real thing. As I mentioned, I know that's what or not what a lot of people want to hear. So let's jump into this quickly. And I'm going to give you 4 reasons why the market now and the market that we experienced in the early 2000s that led to the bubble and then the crash are vastly different. Why things now are not the same. So let me go ahead and share my screen. So to start with, let's look at affordability, right? And I mean, that's a really key factor because when you look at affordability, it's actually made up of 3 different components. It's the price of the home, the wages earned by the purchaser, and the mortgage rate available at the time. Now, according to conventional lending standards, the purchaser shouldn't spend more than 28% of their gross income on a mortgage payment. But things have gotten so expensive. How is it possible that people are not spending 28% of their income on a mortgage payment? Okay, well, they aren't. 15 years ago, prices were high for that time. Wages were considerably lower, and the mortgage rate was over 6%. So even now, prices are still high. They're high, but wages have increased dramatically over the past 15 years. And the mortgage rate, even though it's jumped lately, is still well below 6%. You know, we're bumping right around 4% now. Now, according to the chief product officer of Adam Data, the average wage earner can still afford the typical home across the US, but the financial comfort zone continues to shrink as home prices keep soaring and mortgage rates tip upward. Okay, so what I'm basically saying here is I'm not saying that homes are not less affordable. They are less affordable than they were a year ago or 2 years ago. But less affordable is not the same thing as unaffordable. So as you can see here on this graph, back in 2007, about 34.1% of gross income was being spent on housing costs. Today, that's at 25.8%. Is that higher than where it was? Sure, it is. But it's not in a category that is considered unaffordable at this point in time. The other aspect that we've got to look at is lending standards overall. Okay. During the housing bubble in the early 2000s, lending standards were incredibly lax, right? There was no verification of income. You basically just have to fog a mirror, sign a piece of paper, and you got a loan. And that's exactly what people did. Now, according to credit.org, a credit score of between 550 and 619 is considered poor credit. So basically, anyone below a credit score of 620, the credit agencies consider consumers with credit delinquencies, account rejection, and little credit history as subprime borrowers due to their high credit risk. Well, back in the early and mid 2000s, that didn't stop people from getting a loan. As I'm showing on this graph right here, you can see the volume of loans in billions of dollars made to people below a 620 credit score. I mean, it's a huge number between 2003 and 2007. Comparatively, if you look, that number has fallen substantially from 2008 all the way to 2021. It is much harder to get a loan today, and they haven't been lending money to people that don't deserve to get a loan or qualify to get a loan in the first place. Novel concept, I know. But back then, it was all about funding the loan, funding the loan. We got to get more loans. It was a house of cards that was being built up. And again, it's nothing like that anymore. Now, number 3 has to do with foreclosures, right? So let's take a look at this, right? Now, there's a lot of talk in the news lately about foreclosures. In fact, also over this weekend and at the end of last week, I saw a couple reports that talked about major jump in foreclosure starts. Well, obviously, there's been a major jump in foreclosure starts. There's been a moratorium in effect, right? So I covered this in detail in last week's video. I'm going to put a link below in my February 2022 housing market update. And I talk about that, about foreclosures, and we talk about where the numbers are currently with regards to the forbearance program, because that's where it's coming from. All of these homes were in forbearance, these mortgages in forbearance. So what's happening to them now? Now, it's important to remember as well that foreclosures are a part of every real estate market, good and bad. Foreclosures always happen because life happens, stuff happens, right? People could inherit a house that they can't afford, right? That had a mortgage on it. That home could end up going into foreclosure, right? So there's always foreclosures that are a part of the market. But look at the 4 years between 2007 and 2010, nearly 1.2 million foreclosures in '07. Right, 1.75 in 2008, over 2 million in 2009. Look at the last 4 years, 279,000, 277,000, 129,000, 38,000 in 2021. Now, granted, again, there was a moratorium in effect. I get that. But even as the moratorium's been lifted, you aren't seeing a bunch of homes go into foreclosure. And why is that? Equity. Homes have gone up in value so much that even those that were in trouble have gained equity in their homes. Currently, it's estimated that over 40% of all homes in the country have a minimum of 50% equity in them. Okay, think about that. Over 40% of all homes have at least 50% equity. Currently, tappable equity, tappable home equity is at $9.9 trillion nationwide. That is the highest level it has ever been. An average home equity across the country right now is $300,000. Massive number. So it's a huge difference in why we're not seeing the foreclosure crisis that we saw before. CoreLogic recently said, not only have equity gains helped homeowners more seamlessly transition out of forbearance and avoid a distressed sale, but they've also enabled many to continue building their wealth. Lastly, number 4, supply. Supply is a huge one. And this cannot be overlooked. Back in the early 2000s, I thought it was really strange, to be honest with you. I was in Southern California at the time, and there were plenty of homes for sale, but prices still kept going up. It was like this weird frenzy going on that wasn't making a lot of sense. But it was mainly affecting new construction. New construction, if a new phase was being released, there'd be lines of people. There's lines of people today, I know, but there'd be lines of people lining up for new construction. The idea behind it is many of these people never intended to occupy or live in these homes. They would sign a contract. It's taken 6, 7 months for the home to be completed. And upon completion, within a month, they'd sell it. And that home would have gone up in value 60, 70, 80, $90,000, the way the market was. And they'd simply sell it, move on, make profit, and move on. But in the resale market, we weren't seeing that. There weren't multiple offers. There weren't bidding wars. There weren't people lining up for every single home because there was a massive supply available compared to what we're seeing today. Think about it today. Not only is there virtually no new construction available, there's no resale homes. Currently, this morning in Frisco, Texas, there's 73 active listings for sale. That's in a city of over 200,000 people, 73 homes. That's nothing. That's no inventory. Normally, this time of year, we could be looking at 800 to 900 active homes for sale. 73. So when you look nationwide, look at the supply difference. Remember, 6 months worth of inventory is considered a balanced market that doesn't favor buyers or sellers. Okay, nationally in 2007, we had nearly 10 months supply. 9.5 months in 2008, 7.3 months in 2009, 8.5 in 2010, right? Now look at the last 4 years. It keeps going down, 3.7, 3, 1.9, 1.8. I can tell you here in Frisco, we don't have a month. We've got roughly 2 weeks, if that, maybe 10 days worth of supply. It is still an extremely strong seller's market. There is all kinds of supply constraints going on. And so right now, with those fundamentals in place, we are not going to see the market crash. It's not going to happen. What we are going to see is we will start to see a little bit more balance come into the market, is my belief. You are going to get people right now that are going to get priced out. I understand that. There's many people that are looking that want to live in a specific area that just cannot afford it, right? They are either going to have to come to the realization that they're going to have to move farther out, or they're just going to have to continue renting, right? It's one of those two. For the first-time home buyers, it's tough. They're definitely going to have to go further out. But we will see demand get pulled back. Demand will ease slightly based upon that reason. And more new building permits have been issued, and the builders are doing everything they can to ramp up. Obviously, supply constraints have been a major problem as well. They can't get the building materials, but that should start to ease as we move further into this year. And that will help bring a bit of balance back into the market. So whether you agree with this or not, that's fine. But hopefully this information will help you make the decision that's best for you and give you some of the reasons why I don't believe that we're in a housing bubble right now. And I don't see any signs that prices or anything else are going to come tumbling down in the near future. If you have a specific situation you'd like to discuss in more detail, I invite you to give us a call. Numbers on the screen, or please feel free to email us at contact@s2realestateteam.com.